Introduction: Price versus volume and spread fundamentals. Financial markets operate on structured supply and demand mechanics, yet most retail traders focus almost entirely on price movements, while completely ignoring the underlying engine driving those movements: volume and spread. Price shows you where the market has moved, but volume tells you how much effort was required to achieve that movement, and spread, the difference between the high and low of a candle, reveals the true efficiency or inefficiency of that effort. When you analyze price in isolation without considering volume and spread, you are effectively looking at a speedometer without knowing how much fuel the engine is consuming. Institutional entities, commercial market makers, and hedge funds leave unmistakable footprints through institutional volume and candle spread, which cannot be hidden. Understanding price spread alongside volume provides an accurate reflection of institutional liquidity placement, allowing traders to distinguish between genuine market participation and artificial price manipulation designed to sweep retail stop losses. To analyze price and volume correctly, we must define the relationship between spread and volume. Spread represents the total price range between the period's high and low, reflecting the volatility and net price movement within a specific time frame. Volume represents the total number of shares or contracts executed during that same time period. When spread and volume are aligned, meaning a widespread candle is accompanied by high volume, it indicates active participation and clear consensus between buyers and sellers. However, when spread and volume diverge, such as a widespread candle on light volume or a very narrow spread candle on exceptionally heavy volume, it indicates structural anomaly and institutional intervention. Institutional order flow cannot enter or exit the S&P 500 or Nasdaq futures without generating massive volume spikes. Therefore, watching spread expansion and contraction alongside volume is the primary tool for identifying high-probability market turns. Consider a real-world case study on the SPY ETF during a scheduled FOMC interest rate announcement. Prior to the news release, the market trades in a tight range with low, balanced volume. The moment the rate decision is released, a massive green candle appears with an exceptionally wide spread, moving $3 in a single minute on 4 times the average relative volume. This wide spread, combined with massive volume, confirms aggressive institutional buying pressure, demonstrating that large funds are willingly absorbing selling offers at higher prices. Conversely, if that same wide green candle occurred on below average volume, it would signal a low liquidity squeeze, a price movement driven by a lack of liquidity rather than strong institutional commitment, which frequently results in a rapid and complete reversal once sell orders enter the book. The foundational principle governing volume spread analysis is the law of effort versus result, originally articulated by Richard D. Wyckoff. In financial markets, effort is measured directly by the volume of shares or contracts traded, while result is represented by the price progress made, measured by the candle's spread and closing level. Under normal, balanced market conditions, effort and result should be directly proportional. A significant increase in effort, high volume, ought to yield a substantial result, a widespread candle and a directional close. When this proportion breaks down and effort fails to produce an equivalent result, an anomaly exists in the market. This structural imbalance reveals that powerful market participants are actively absorbing orders on the opposite side of the prevailing trend, laying the groundwork for an impending trend reversal. To master effort versus result, traders must evaluate specific scenarios where volume and spread display clear divergence. Suppose a stock is in an established downtrend and approaches a major daily support level. A large red candle appears with extremely high volume, representing massive effort by short sellers pushing the market down. However, despite this extraordinary volume, the candle closes near its high with a narrow spread, showing almost no downward progress. The high volume indicates that aggressive selling occurred, but the narrow spread proves that institutional buyers were stepping in and absorbing every available sell order at that price level. The massive effort to push prices lower failed to produce a bearish result, signaling that aggressive sellers are exhausted and that institutional accumulation is taking place behind the scenes. A clear historical case study of effort versus result occurred in Apple stock, AAPL, during a quarterly earnings reaction. During the regular session preceding the announcement, AAPL pushed to new daily highs on massive volume that reached 3 times its 50-day average. Despite this extreme volume effort, the daily candle closed as a narrow-body doji with long upper and lower wicks, gaining less than 0.2% on the day. The market displayed extraordinary effort, massive volume, but virtually zero result, narrow price progress. Institutional funds were using the retail enthusiasm around earnings liquidity to unload large positions into buying demand without pushing the price higher. Over the subsequent 2 weeks, AAPL experienced a 12% downward correction, confirming that the high volume on narrow spread was, in fact, institutional distribution disguised as a breakout. Identifying institutional inflection points requires a precise operational understanding of classic volume patterns, starting with stopping volume and the buying climax. Stopping volume occurs at the end of a prolonged markdown or downtrend and signifies that smart money is actively stepping in to stop the price decline. Graphically, stopping volume manifests as a high-volume candle, often with a wide total range but a close well off its lows, that appears after a sustained drop. The extremely high volume indicates intense selling pressure from retail traders panicking out of positions, while the long lower shadow and failure of the price to close at the low confirm that institutional buyers are absorbing that sell flow. Stopping volume does not guarantee an immediate V-shaped reversal, but it marks the official end of an effortless markdown phase and signals the beginning of accumulation or range-bound consolidation. The counterpart to stopping volume is the buying climax, which occurs at the terminal stage of a mature bull trend. A buying climax represents the final burst of aggressive buying, typically fueled by retail FOMO, breaking news, or breakout buyers chasing higher prices. The price surges higher, creating a widespread green candle accompanied by ultra-high parabolic volume. However, while retail traders view this explosive move as the start of a new rally, smart money uses this surging liquidity to distribute their long positions to enthusiastic late buyers. The definitive sign of a buying climax is when this ultra-high volume fails to generate follow-through in subsequent sessions, often followed by price closing back inside the range of the climax candle, or forming a prominent upper tail, marking the absolute ceiling of institutional demand. A concrete case study of stopping volume can be observed in Tesla, TSLA, during a sharp, broader market pullback. After declining 7 consecutive sessions, TSLA opened with a massive gap down on heavy negative news sentiment. Within the first hour of trading, volume hit record highs for the year. However, instead of driving lower, the price stabilized, forming a widespread candle with a massive lower wick and a close in the upper third of the range. The extreme effort, record volume, failed to keep the price down because institutional market makers absorbed all panic selling, establishing a firm price floor. Conversely, a classic buying climax occurred in Bitcoin, BTC/USD, during its push toward historical highs, where parabolic volumes spiked to multi-month highs on a massive green candle, only for the next 3 days to trade completely inside or below that candle's range, leading to a structural multi-week sell-off. Volume divergence represents one of the most reliable analytical tools for detecting weakening momentum and predicting structural market turns before they appear on standard lagging indicators. Volume divergence occurs when price makes a higher high or a lower low, but the accompanying volume fails to confirm the new price extreme by printing lower relative volume. When price advances to a new swing high on declining volume, it demonstrates a lack of institutional buying interest at higher levels. The market is moving higher simply due to a temporary absence of sell orders, not active buying aggressive demand. Conversely, When price drops to a new swing low on decreasing volume, it reveals that selling pressure is drying up, indicating that short sellers are running out of steam and market supply is completely exhausted. To trade these structural shifts effectively, quantitative market participants combine volume divergence with advanced spread strategies, specifically measuring the spread-to-volume ratio across key market structures. In an upward trend, a trader analyzes the spread of up candles relative to down candles. If up candles show narrowing spreads on declining volume, while down candles exhibit expanding spreads on increasing volume, the internal health of the trend is broken, regardless of what price appears to be doing. Spread strategies also analyze the concept of no demand and no supply bars. A no demand bar is a narrow spread up candle on volume significantly lower than the previous two candles, confirming that institutional participation is completely absent on the buy side and signaling a prime opportunity for short positioning at resistance. Consider a detailed case study of volume divergence on the E-mini S&P 500 futures, ES, on a 15-minute chart during a retest of the daily high. The market initially rallied to 5,000 on high volume and widespread candles. After a minor pullback, the market pushed higher again, printing a new high at 5,008. However, an analysis of the second leg revealed that the spread of the up candles had contracted by 40%, and total volume on the breakout was 50% lower than the volume recorded on the initial push to 5,000. This clear volume divergence signaled that institutional buyers did not support the new high. Professional traders executing spread strategies used the subsequent no-demand, narrow-spread candle at 5,008 to execute short positions, targeting the lower boundary of the trading range with an exceptional reward-to-risk ratio. Institutional order flow, case studies, and practical framework. To successfully integrate volume spread analysis into a professional trading framework, traders must understand how institutional order flow operates within major market structures like liquidity pools, order blocks, and fair value gaps. Institutions manage billions of dollars and cannot enter or exit market positions with a single market order without incurring massive slippage. Therefore, they must build positions systematically over time through accumulation and distribution phases. They engineer liquidity by driving price beyond obvious retail support and resistance levels, triggering retail stop-loss orders, which creates the exact counter-liquidity needed for institutions to fill massive orders. Analyzing volume and candle spread allows you to see whether a break of a key level is a genuine institutional breakout or an engineered liquidity sweep. A comprehensive case study demonstrating this institutional dynamic occurred in NVIDIA, NVDA, near a major multi-month resistance zone at $120. As the price approached $120, retail breakout traders entered long positions, while short sellers placed stop losses just above the level. The price briefly broke through $120, reaching $122 on an initial burst of volume. However, detailed spread analysis showed that the candle spread was narrow relative to the massive volume spike, and the close occurred near the bottom of the range. Institutions were using the liquidity provided by retail breakout buyers and short covering stops to unload massive long positions. 2 days later, a high-volume down candle with a wide spread confirmed structural distribution, and NVDA dropped 15% over the following 3 weeks, rewarding traders who analyze the spread anomaly over price narrative. To systematically execute volume spread analysis in your own trading, follow a precise 4-step analytical checklist on every trade setup. First, define the overall market structure and identify critical daily liquidity zones, support, and resistance levels. Second, evaluate the effort versus result relationship by comparing the candle's spread to its underlying volume relative to recent average volume. Third, scan for explicit institutional footprint patterns, such as stopping volume at key support, buying Climax at resistance, or persistent volume divergence at new highs or lows. Fourth, wait for explicit confirmation through a spread contraction, such as a no supply bar before taking a long trade, or a no demand bar before taking a short trade, ensuring your entry aligns precisely with institutional liquidity flow rather than retail speculation.